So, you want to own a gym. The pitch sounds almost unfair. Put a room full of machines behind a keycard door, collect a monthly fee, and let the direct debits do the lifting. But the first thing a gym owner learns is that the equipment does not make this a fitness business. The lease makes it a real estate business. The billing system makes it a subscription business. The trainers make it a service business. And the crowd at 6 o'clock makes it a capacity business. To see how those businesses collide, we are going to open one. Our gym is independent, mid-market, and 7,500 square feet. It opens with 600 members, 2 pricing tiers, personal training, and enough equipment to look complete without trying to imitate a 20,000 square foot national chain. Before the doors open, it needs roughly $1.39 million. Then the real test begins. Can the owner sell enough memberships to cover the clock without selling so many peak hour visits that the room becomes unusable? Gym is not one business model. A budget gym sells access at a low price to a very large membership base. A premium club sells space, amenities, and status. A boutique studio sells a scheduled class with high revenue per square foot. A strength gym sells specialized equipment and community. A personal training studio sells coaching time. Each model has a different bottleneck. Budget gyms need scale. Premium clubs need expensive amenities. Studios need full classes. Training businesses need productive coach hours. Our gym sits in the middle. 75% of members pay $44 a month. The rest pay $69 for a higher tier. Annual and administrative fees add an average of $3 per member per month. That sounds simple, but a mid-market gym inherits the cost of a real facility without the scale advantage of a national low-price chain or the extreme pricing power of a boutique studio. The owner is not choosing decor. The owner is choosing the economic engine. The model starts with $562,500 of leasehold work. Flooring, showers, electrical upgrades, walls, lighting, and all the unglamorous pieces that make a retail shell behave like a gym. Fitness equipment adds $350,000. That is not a fantasy number pulled from a pile of dumbbells. A single commercial-style treadmill can list for roughly $7,600 to $11,000 depending on configuration. Multiply that across cardio, racks, cable machines, benches, plates and delivery, and the floor becomes capital-intensive very quickly. Furniture, access control, cameras and technology add $80,000. Permits, design, professional fees, and pre-opening expenses add $65,000. Deposits add $35,000. So the physical opening consumes about $1.09 million. Then we add $300,000 of working capital. That money does not improve the mirrors. It buys time while membership catches up with the rent. Total startup capital, $1.3925 million. In our case, the owner contributes 40%, or $557,000. The remaining 60% is financed for 7 years at an illustrative 9% rate. Monthly debt service is about $13,442. The gym has not sold a single workout yet, and one bill is already doing reps every month. Once the doors open, 6 bills dominate the month. Rent and common area charges, $16,500. Payroll and benefits, $25,000. Utilities, $7,000. Marketing, $5,000. Maintenance and supplies, $5,000. Insurance, software, licenses, and administration, $6,000. That is $6,450 of fixed cash operating expense, before payment losses, trainer payouts, product costs, or debt service. National chains describe rent and labor as fixed or semi-fixed for a reason. When membership falls, the landlord does not remove 20% of the building. The front desk cannot work only when a member scans in. The shower still needs hot water. The treadmill still breaks. This is operating leverage. Once revenue rises above the fixed base, additional members can be very profitable. Below the fixed base, every empty month is expensive. The clock is what makes a gym feel better at 1,500 members than at 1,000, even if the room looks almost identical. Here's where the usual explanation goes wrong. Gyms are often described as businesses that profit from people who never come. That is too crude, and current data pushes against it. The Health and Fitness Association estimates that only 4.6% of U.S. members made 0 facility visits in 2025. The better mechanism is time sharing. Industry-wide, 81 million members generated nearly 7 billion visits in 2025. That works out to roughly 86 visits per member year. A person can be a real active customer and still use only a tiny fraction of the gym's available hours. At the end of our model, the gym has about 1,695 members. Using that industry-wide visit rate, it produces roughly 155,000 annual visits. That sounds impossible for a 7,500 square foot room until we distribute the visits. With a 75-minute average stay and 17 operating hours per day, the model has about 31 people inside at an average moment. Apply a 3 times peak factor, and the busy period reaches about 94 people. Our comfortable peak assumption is 110. So nearly 1,800 active members can share the gym while peak utilization remains around 85%. The economic asset is not simply the floor. It is the floor multiplied by time. That is why a gym can sell far more memberships than bodies it can hold at once without relying on thousands of people to vanish. But it is also why the afterwork peak matters so much. If attendance becomes synchronized, the business can be healthy on paper and miserable in person. New Year demand is real. Placer.ai measured gym visits in January 2025 at 21.2% above the previous month. For an owner, that surge creates 2 very different opportunities. The obvious opportunity is sales. Prospects are motivated, tours increase, and paid acquisition can convert faster. The less obvious opportunity is measurement. January exposes the true bottleneck. Are there enough racks? Are check-ins slow? Are classes full? Does the locker room fail before the gym floor does? Does parking become the capacity limit? The wrong response is to design the whole year around January's busiest hour. That leaves expensive capacity underused for the other 11 months. The other wrong response is to ignore the peak and celebrate every sign-up. Overcrowding turns new revenue into future churn. The owner's job is to decide which congestion is temporary, which is structural, and which can be shifted to a different time with pricing, programming, or access rules. At mature scale, our blended monthly membership revenue is just over $53 per average member before personal training, groups, and retail. Payment processing and failed collections consume 4% of membership billings in the scenario. Personal training revenue pays 45% to the trainer. Group and retail income have their own direct costs. After those variable costs, one average member contributes roughly $55 a month toward fixed overhead and debt. That makes the break-even point about 1,412 average members. Below that line, the owner is buying time. Above it, the same lease begins to produce cash. This is why underpricing can be more dangerous than an empty treadmill. A $5 discount across 1,500 members removes $7,500 of monthly revenue. The rent does not notice that the owner was trying to be competitive. A low price is not a strategy by itself. It only works if the space, staffing, and acquisition system can support the membership volume it requires. Membership businesses leak. At a 4% monthly churn rate, a gym with 1,800 members loses about 72 members every month. It must replace those 72 just to stand still. At 7% churn, it needs 126 new members a month before it grows by 1. That difference is not a spreadsheet detail. It changes the entire building. More sales staff, more advertising, more tours, more onboarding, more people entering through the front, while disappointed members leave through the back. Our model starts with 600 members and aggressive early sales. It crosses monthly cash break-even in month 8. But because the opening months lose money, cumulative operating cash does not turn positive until much later. The maximum modeled cash draw is about $136,000. That is why we funded a $300,000 runway. A gym can be profitable at maturity and still fail during the climb. Break-even tells you where the business works. Runway tells you whether the business lives long enough to get there. The temptation in a subscription business is to treat cancellation friction as retention. It is not. Hard-to-cancel memberships can postpone churn on a dashboard while creating complaints, chargebacks, and legal risk. New York secured $600,000 in penalties from Equinox over cancellation practices. New York State already requires online cancellation in certain online contract situations. New York City has also finalized a broader click-to-cancel rule that, at the time of this research, has not yet taken effect. The federal picture is different. The FTC's nationwide click-to-cancel rule did not take effect after a court decision. That mix of state, city, and federal rules is exactly why an operator cannot copy a cancellation policy from a competitor and call it compliance. But the economic lesson is larger than the law. Real retention comes from early habit formation, clean equipment, predictable crowding, useful coaching, and a price that still feels fair after the January motivation fades. A member who can leave but chooses to stay is an asset. A member who stays only because leaving is exhausting is a liability with delayed timing. Membership dues monetize access. Personal training monetizes attention. HFA reported that 23% of facility members used a personal trainer in 2024, averaging 21 sessions during the year. That does not mean every gym can sell coaching to 1/4 of its base. It does mean coaching is large enough to model deliberately. In our scenario, 7% of average members buy one $75 session in a month. The trainer receives 45%. At the end of the ramp, that produces a little over $9,400 of monthly training revenue and about $5,200 before shared overhead. The room already exists. The lead already pays membership dues. The incremental capital is small, but personal training is not free margin. It depends on coach availability, sales skill, client consistency, and scheduling. An unused trainer hour expires. A great trainer can also leave and take relationships with them. The best operators treat coaching as a managed service line with utilization, payroll split, conversion, and retention, not as a magical upsell percentage. Gyms have a habit of making ordinary bills feel trivial beside the rent. Music is a good example. Playing music publicly involves performance rights. Performing rights organizations offer blanket licenses because clearing songs one by one would be impractical. The license belongs in the operating budget. Ignoring it does not turn the music free. U.S. copyright law allows statutory damages from $750 to $30,000 per work and up to $150,000 for willful infringement. Equipment maintenance behaves the same way. A loose cable, worn belt, or broken screen begins as a repair cost. Left alone, it becomes downtime, a bad review, or an injury claim. Large franchise systems make replacement cycles explicit. Planet Fitness says its franchisees generally replace equipment every 5 to 9 years. Independent owners do not escape that cycle. They simply get to decide whether to reserve for it before the machines fail or borrow after they do. A franchise can offer a brand, site standards, buying power, billing systems, and a playbook. It also introduces royalties, required vendors, remodel obligations, and less freedom. And it is not always the beginner-friendly shortcut it appears to be. At Planet Fitness, 98% of franchise clubs are operated by groups that own at least 3 locations. The mature corporate clubs disclosed about $2 million of average unit volume and very high four-wall margins. But those results belong to a 20,000 square foot high-volume, low-price system with national scale. They are useful as proof that the model can work. They are not a promise that a first-time owner can reproduce the economics in a smaller independent unit. Independence removes royalties and brand rules. It also removes the brand, the data set, and the purchasing machine. The decision is not freedom versus fees. It is whether the system you are buying is worth more than the constraints and payments it adds. Gym failures are often explained with one dramatic sentence: too much debt, too many clubs, bad management, or an external shock. Reality stacks causes. 24 Hour Fitness filed Chapter 11 during the pandemic, when forced closures crushed revenue. That is an extreme case, not a normal operating benchmark. But it exposes the fragility of a business with leases, debt, and large fixed costs when visits and collections suddenly stop. Bally's history adds a different warning. Its bankruptcy restructuring and later SEC accounting actions show how reported performance can separate from cash reality. For a single owner, the lesson is not that every gym is one crisis from bankruptcy. It is that the income statement, debt schedule, and cash account must tell the same story. A packed room does not prove profitability. Revenue does not equal cash. EBITDA does not pay principal. And a positive month does not erase 6 negative ones that came before it. Consider 3 versions of our gym. Owner 1 opens beautifully, charges too little, and stalls near 1,000 members. Customers like the place. The economics do not care. Contribution never catches the fixed cost clock, and working capital drains. Owner 2 reaches 1,800 members, but lets churn rise to 7%. Now 126 replacements are needed every month. Marketing becomes life support, the peak gets crowded, and growth feels busy without becoming durable. Owner 3 reaches roughly the same membership with 4% churn, keeps peak utilization below the comfort limit, and builds personal training without overscheduling coaches. In year 2, the model produces about $1.27 million of revenue, $383,000 of EBITDA, and $222,000 of pre-tax cash after debt service. That is an attractive result, but it rests on assumptions, not destiny. Higher rent, slower joins, lower pricing, heavier payroll, or a more expensive equipment package can move it quickly. The point of the model is not to predict one owner's return to the dollar. It is to reveal which variables can kill the business before the owner signs the lease. So you still want to own a gym? Then do not begin with the machines. Begin with the capacity map. How many people can the space serve comfortably at the busiest hour? How many active members can share that capacity across the week? What price covers the lease without requiring impossible volume? How many members leave each month? How much cash is lost before break even? Which services add contribution without creating a new bottleneck? A gym does not win by maximizing attendance, and it does not win by hoping members disappear. It wins by selling access people value, distributing usage across time, keeping churn honest, and surviving the ramp between opening day and operating scale. The weights are the visible product. The real business is the flow of members, minutes, and money through the same fixed room.